Welcome to The Explainer. Today, we're going to pull back the curtain on a really powerful strategy that savvy investors use. We're going to break down how they use real estate not just to build wealth, but to legally and systematically crush their tax bills. So let's just dive right in with a pretty powerful question. For most high-income professionals, doctors, lawyers, people in tech, investing is all about growing their capital. But what if, and this is a big what if the main purpose of a real estate portfolio wasn't just rental income, but to generate paper losses that directly reduce the taxes you're paying on your main salary? In this slide, it really highlights a massive shift in thinking. A traditional investor looks at a rental property and asks, okay, how much cash flow does it generate? But an expert, they look at that exact same property and ask, how big of a tax deduction can this thing create to offset my salary? It's a completely different game, a totally different playbook. Okay, so how does this tax engine actually work? Well, to really understand the strategy, we first have to understand the roadblock the government put up specifically to stop this from happening. Yeah, it all boils down to something called the passive activity loss rules. See, way back in the 80s, high earners were using real estate losses to basically wipe out their job income. And the government, they weren't a fan. So they created this rule. Think of it like a big wall between your passive rental losses and your active job income. This entire strategy, it's all about finding the legal keys to unlock a gate in that wall. Okay, now for the fuel. What makes this whole engine run? It's something called paper losses. The trick, and it's a brilliant one, is to generate these huge, totally legal losses on paper from a property that in the real world is actually gaining value and spitting out cash. I know, it sounds like a total paradox, but this is the absolute core of the whole mechanism. And that main mechanism? It's called depreciation. You see, the tax code actually lets you take a deduction for the expected wear and tear on a building, even while its market value is climbing. Now, for a residential property, this paper loss is typically spread out over a long 27.5 years. But come on, the really savvy investors, they're not waiting almost 3 decades. No way. They use this incredibly powerful tool called a cost segregation study. Basically, an engineering firm comes in, analyzes the property, and separates all the bits and pieces, like the carpets, the appliances, the fixtures, from the main structure of the building. And these non-structural items can be depreciated way faster. We're talking 5, 7, or 15 years, which pulls massive deductions right into the first few years of owning the property. And the impact here, it is absolutely stunning. According to expert analysis, a cost segregation study on a property with, say, $1 million building value could unlock a $220,000 deduction in year 1 alone. That is the high-octane paper loss we need to fuel our tax engine. Okay, listen up, because this is probably the most critical part of the entire strategy. We've generated this massive paper loss, right? But it's still trapped behind that passive wall. So, how do we turn the key and finally use it to offset the active income from our day job? Well, according to tax experts, there are 2 main legal pathways around that wall. You can think of them as 2 different keys, and each one is designed for a different type of investor. And this slide lays out that strategic choice. To qualify as a real estate professional, you've got to spend over 750 hours a year on it, and it has to be more than half your total working time. For a busy doctor or engineer, that's nearly impossible. The short-term rental loophole, however, is so much more accessible. It typically requires around 100 hours of what's called material participation, making it the go-to strategy for high earners with those really demanding careers. Okay, so we have the tax engine, but a single property is just one component. To build some serious wealth, you need a system to acquire more properties. An assembly line that lets you recycle the same capital over and over and over again. And a lot of investors use this really powerful framework for this, known as the BRRRR method. That stands for buy, rehab, rent, refinance, and repeat. It's this super disciplined cycle that's all about adding value to a property and then pulling your initial investment right back out. So the magic, it really happens in that refinance step. The new loan isn't based on what you paid for the place, it's based on the new, higher value of the renovated property. This often lets you pull out all of your original down payment and rehab costs. That cash out then becomes the down payment for the next property, letting you scale your portfolio without waiting years to save up again. Now look, this is a seriously powerful, advanced strategy. But just like any high-performance engine, it can totally blow up if it's not built on a solid foundation. And the biggest mistake is letting the allure of a huge tax deduction cause you to ignore fundamental investment principles. And the experts are crystal clear on this. If you fail on the fundamentals, the whole tax strategy just fails. Buying in a bad location, skipping a thorough inspection, rushing tenant screening, or buying a property that loses cash every month. These aren't small mistakes. They are foundational cracks that can bring the entire structure down.
All right, finally, let's talk about the fortress. Once you've built this asset base and the income stream that comes with it, you absolutely have to protect it.
The goal here is actually pretty simple. You want to build a legal firewall between your business risks and your personal wealth. So if a tenant slips and falls at one of your rental properties, that lawsuit should never ever be able to touch your family home or your savings. A commonly recommended structure for this is what's called the T formation, and it's just a really clean way to organize everything. At the base, you have a trust for estate planning. Then, on one side of the T, you use limited liability companies, or LLCs, for your active businesses. And on the other side, you use separate LLCs to hold your passive assets, like your rental properties. And this is why a structure like this is so darn powerful. Any liability is contained within each individual LLC. Your personal name is shielded from public records, enhancing your privacy. It forces clear financial organization, and the trust at the base simplifies passing this wealth to the next generation. It's a complete financial fortress. So as we wrap all this up, the final takeaway here isn't a statement, it's a question. The blueprint we've just deconstructed is about way more than just making money. It's about building an interconnected financial system where your investments, your tax strategy, and your asset protection all work together. So the question to leave you with is, are you just earning an income, or are you building a system?